Hello and welcome to our new investment strategy update. The second half of the year holds some major risk events, notably in politics. But the good news is that the economic picture looks moderately healthy. The world economy is growing with a recovery in regions and sectors that have lagged US outperformance. Manufacturing and services are expanding, trade is rising, and productivity is picking up, particularly in the US. With a still resilient labor market, recession risks remain contained in the world's largest economy. And even China's activity is no longer deteriorating thanks to authorities' effort to redirect credit from real estate to industry and manufacturing. Falling inflation has opened the door to a rate-cutting cycle in developed markets. The Federal Reserve will be among the last to ease policy, but we expect a first interest rate cut in September. And after the Fed cuts, we expect US rates to decline gradually whilst remaining much higher than pre-pandemic levels. Of course, the list of risks is long. Inflation may come back and public debt keeps rising. Political risks in Europe, US elections, and geopolitical tensions will, at times, take the wheel in the coming months, bringing more market volatility. But so far, the impact of politics and geopolitics on the real economy has been contained. Why so? Well, because the two key transmission channels, energy markets and supply chains, are not showing much signs of stress, whilst private savings remain abundant and are helping to offset public borrowing. Put it simply, the private sector in the main economies is benefiting from much improved financial health compared with 15 years ago. At the same time, strategic competition is redrawing trade routes and driving public and private investment into a wide range of sectors worldwide. After securing its energy independence, the US has now set its sights on retaining its strategic lead in sophisticated semiconductors. This looks like a new cycle in capex expenditure. So what does this all mean for investments? Well, for now, we keep our overall portfolio risk, fixed income and equity exposures at strategic levels. In fixed income, we still favor high-quality bonds and continue to capitalize on opportunities to lock in today's high yields. In sovereign debt, we like German Bunds and UK gilts. Elsewhere, selected European investment grade, global crossover credit, and emerging market corporate bonds also offer opportunities. In equities, solid corporate earnings growth for the rest of 2024 and falling interest rates should keep pushing most markets higher. Improving growth should particularly benefit cyclical stocks. We expect sectors and regions that have lagged so far this year to recover further. In time, the extreme concentration of US equity returns should normalize somewhat. We favor UK stocks among regions and communication services, energy, materials, and consumer discretionary in sectors. The sustainability transition, but also political tensions, should continue to support demand for commodities. We are positive on the industrial metals underpinning the transition, as well as on gold, which should continue to benefit from central banks' demand as they diversify their reserves. In currencies, we maintain our US dollar exposure. The dollar offers a yield advantage over other developed market currencies and benefits from US growth and its haven status amid geopolitical risks. We expect support for the dollar to build in the run-up to US elections. The Swiss franc is another haven currency that could see some support through a politically turbulent summer. Now, for eligible investors, private assets can also fill a very useful portfolio function, not just for long-term performance and diversification, but also to access growth opportunities in some of the world's most innovative firms. These benefits target a longer time frame. In the near term, we will employ highly active portfolio management and a disciplined risk approach to navigate a summer of extraordinary political risk. Thank you so much for watching.